I'm Basil Neelambra, tutor for financial reporting. In this video, I'm going to debrief section B of FR September 2024 mock exam. As you know, in section B, there will be 3 objective type cases. Each case will contain 5 objective type questions. So in total, 15 objective type questions, each carrying 2 marks. So total 30 marks from section B. So let's read the first case scenario, which is Bollinger Company. The company is finalizing its financial statement for the year ended 31st December X6. There are 3 transactions which still need to be accounted for. On March X6, so remember the financial year ending is 31st December X6. Something has happened in March X6. So there might be a time proportionment involved. A sale was made of a high-tech medical scanner that included a 5-year support plan. The total sales price was 2.4 million, paid on March X6, and scanner was delivered on the same date. Individually, the scanner would be typically sold for 2.1 million, and a 5-year support plan ordinarily sell for 400,000. So you have to understand that there is a combo offer because a scanner will be typically sold for $2.1 million, and the 5-year support is normally sold for 400,000. 5-year support, which will be an income, is normally sold for 400,000. So the total price or transaction cost of this separately, if sold, is 2.5 million. Now that is being offered at a combo offer of 2.4 million. So it is offered at a discounted price or a combo offer. A sale was made of a high-tech medical scanner that included a 5-year sale plan, and the total selling price on March X6 was 2.4 million. So there's a combo offer, which you have to remember. So maybe one of the question will be to split this combo offer of 2.4 million into scanner and into 5-year support. And you might have done similar question. This 5-year support is a deferred income. It will have to be split into current and non-current liability. Maybe the questions can be that a student who have done adequate question practice should be able to predict what could be the questions. 15 September 20XX, another date in this particular financial year, and an industrial machine sold by Bollinger in February X6, that is during the current year, was found to be defective, and several parts were replaced by Bollinger under warranty. Bollinger would typically sell the replacement part for 120,000. The total cost to Bollinger for this replacement parts was 75,000, something about replacement, warranty, etc. November X6, 2 months before the year ended, December X6, Bollinger entered into a contract for sale of product for 300,000. Bollinger received 300,000 on November X6. Bollinger has the right to repurchase these goods on May X7 for 370,000. So there's a repurchase agreement. So you should, maybe one of the question could be related to repurchase agreement. So now let's read the first question of case scenario number 1. 16th question. In accordance with IFRS 15, revenue from contract with customers, which 2 of the following criteria are required for an entity to account a contract? The contract must be in writing. No, it's not a revenue recognition criteria to record revenue from a contract. Collection of consideration must be probable. Yes, there must be probable economic benefit. It must be certain that the amount will be collected, more than 50% chance. So yes, it is one of the principle of revenue recognition. The contract must have commercial substance. Yes. The contract must be associated with a bank. No. So B and C is the answer. Next one is also a narrative type question, a theory question. Under IFRS 15 revenue from contract, how should the transaction price be allocated to all the performance obligation in the contract that are met over time? Transaction price means how we are going to allocate the selling price to the performance obligation of a contract that is met over a period of time. So normally it will be recognized over a period of time. Let's see what are the options given in the question. Based on the NRV of components at the start of the contract, equally spread over the entire contract duration, allocated according to the total estimated cost of component parts. Revenue shall be recognized by measuring progress of completion. That is the answer. Revenue will be measured by measuring the progress of completion. If 10% is complete, then 10% of revenue should be recorded. If 70% is completed, then 70% of revenue should be recorded. It is based on progress of completion, percentage of completion. The third one is a problem. For the sale of high-tech medical scanner, what amount of revenue should be recognized for the support plan till 31st December X6? This is an area where in the mock exam of CAPENS, most of the students have committed a mistake. They are asking about how much revenue should be recorded for the support plan. What is a support plan? There are two performance obligations in the question. One, high-tech medical scanner, which is a product. And second one, a 5-year support plan. So they're asking how will you record the 5-year support plan income? We have already identified that. That is, this is a compo offer. So in case of compo offer, there is a scanner, medical scanner, and there's a 5-year support plan. So they're asking how much revenue should be recorded. So first we have to find out the transaction price of scanner and transaction price of 5-year support plan. So the compo offer is 2.4 million. Out of that, support plan is 400,000 out of 2.5 million. The split is like that. 2.4 million is the compo offer. The transaction price should be split into scanner and 5-year support plan based on their standalone selling price. So scanner 2.1 million out of total 2.5 million and 5-year support plan 400,000 out of 250,000. So we don't need to know how much of the transaction price should be allocated to medical scanner. The question is about 5-year support plan. So how much transaction price of this compo offer of 2.4 million will be allocated to 5-year support plan? 2.4 million is the compo offer multiplied by the standalone selling price 400,000 out of 2.5 million. That is equal to, if you use the calculator, you can see that it's 384,000. So let's use the calculator and find out the amount. 2.4 million multiplied by 400,000 divided by 250,000. That is equal to 384,000. Let's try one more time. There is some mistakes here. So let me delete this. So 2,400 multiplied by 400 divided by 2,500. In thousands, it is 384. So 384 thousands. So that is a transaction price. The question is not asking about the transaction price. The question is asking how much revenue should be recorded. So 5-year support plan. So revenue will be 384,000 divided by 5. Not it over. Time proportion. That is for a 1 year. We don't have 1 year because a sale was made on 1st March XX and year end is 31st December. So March, April, May, June, July, August, September, October, November, and December, 10 months multiplied by 10 by 12. So 384,000 multiplied by 10 by 12 equal to 3. It's not 384,000. It is 384,000 divided by 5. We didn't do that. So 384,000. That is for full 5 year divided by 5. That is 76,800 for a year. Multiplied by 10 by 12, that is equal to 64,000. So the revenue to be recorded is 384,000 divided by 5, since it's a 5-year plan. But we don't have full year. It's from March to 31st December, 10 months. So into 10 by 12, 64,000. So the answer is 64,000. You have to be very careful when you input fill in the blanks question. They're asking total. So enter 64,000 can be shown. Now the next question. Which of the following statement is correct regarding warranty work undertaken on 15th September 20XX? Cost of sales will increase by 120,000. Revenue will increase by 120,000. Revenue will decrease by 75,000. Cost of sales will increase by 75,000. So 15 September X5 warranty. So let's read 15 September X6 warranty. An industrial machine sold by Bollinger Company in February X6 was found to be defective, and several parts were replaced by Bollinger under warranty. So under warranty means that the customer will not pay anything for the repair or replacement. The entity will have to replace the item from its own pocket. So the cost will have to be borne by the entity. Bollinger would typically sell the replacement part for 120,000. They're not worried about that. We need to know what is the cost of the replacement part, because that is the expense that Bollinger have to pay from its pocket. So the total cost of Bollinger for this part is 75,000. So the expense they have to incur for replacing this is 75,000. So cost of sales will increase by 75,000. It is basically inventory being used to replace, or cost to replace that. Now, the last question, 20th question, is about repurchase agreement. For the year ended 31st December XX, match the amount that Bollinger should recognize in financial statement for the contract with option to repurchase. So now let's read the 1st November X6 repurchase agreement. Bollinger Company entered into a contract for sale of products for 300,000. Bollinger received 300,000 on November X6. Bollinger has the right to repurchase these goods on May X7 for 370,000. So they received 300,000 and they are repurchasing this at 370,000. They are paying more. We have learned in IFRS 15 revenue, if the repurchase price is more than the original price, then it should be recorded as a liability. It should be recorded as a liability. So how much will be the liability? So they're asking how much is revenue, how much is finance cost, how much is cash, how much is liability. So revenue is basically zero because this is not recorded as revenue. It's a liability. How much is the cash? The cash is 300,000. They have received 300,000. They have sold product, but it's a repurchase agreement at a higher price. So it's not revenue. It should be recorded as a liability. What if repurchase price is lower than original price? It is accounting as lease. So repurchase, there is no revenue being recorded. If the repurchase price is lower than original price, recognized as a lease. If repurchase price is more than the original price, like this case, the original price is 300,000 and repurchase price is 370,000. So repurchase price 370,000 is more than original selling price of 300,000. So it should be recorded as liability, not revenue. So revenue, zero. What about the cash? The cash that is received is 300,000. So cash will be 300,000. Now, what about the finance cost? So finance cost, 300,000 is the amount, but the repurchase price is 370,000. There is extra 70,000, which is basically finance cost. The extra 70,000 is basically a kind of interest finance cost. But you have to read the scenario very clearly. The transaction occurred on November X6 and the repurchase is on May X7. So how many months are there from 1st November to 1st May X6? November, December, January, February, March, and April. Don't consider 1st May, it's only 1 month. Sorry, 1 day. So 6 months from 1st November to 1st May, there are the 6 months. So 1st November to 1st May, it's basically 6 months. So this finance cost should be recorded over a period of 6 months. So 700 into 6. But why into 6? That is 6 months divided by 6. But that is from 1st November till 1st May. Our financial year ends on 31st December. So there are only 2 months in this financial year. So November and December. So out of finance cost of 700,000 to be recognized over a period of 6 months, 2 months pertains to this current year. So 70,000 into 2 by 6, use your calculators to find out the value. 70,000 multiplied by 2 by 6, that is 23,333. So $23,333 will be recorded as finance cost. And what about the liability? So the liability is going to be the 300,000 cash received plus this 2 months finance cost. So liability to be recorded at 31st December is 323,333. So this is our final answer. Revenue is zero, always zero in case of repurchase agreement. Cash received is 300,000. Finance cost, the 70,000 is from 1st November to 1st May, 6 months. So 700,000 into 2 by 6, finance cost 23,333, and liability will be the cash received plus the finance cost 323,333. So you'll have to drag and drop this to according to the correct figures, revenue zero, etc. You'll have to drag and drop it. Now, case number 1 over. Moving on to the second case. Now, this is an intangible asset question. So the first question is pretty much a narrative question. So we can directly read the question. In accordance with IAS 38 intangible asset, which of the following is a requirement for amortization of intangible asset excluding goodwill? So they're asking which of the following is a requirement for amortization. Irrespective of useful life, intangible assets should not be amortized. That is wrong. Intangible asset can be amortized over the useful life. Intangible asset should be evaluated for impairment annually without charging amortization. That is also wrong. Intangible asset need to be evaluated for impairment only if there are indicators of impairment. Otherwise, no need. But we have learned that two intangible assets require impairment review every year. Which are they? Intangible asset with indefinite useful life and goodwill on business combination, that is purchased goodwill, have to be reviewed annually for impairment. Other asset is required to be evaluated for impairment only if there are indicators. So that is not correct. They're saying that intangible assets should be evaluated for impairment annually. That is wrong. Intangible assets should be amortized according to the expected pattern of economic benefits of consumption. That is true. But let's read the last one to make sure. Intangible assets should always be carried forward at original cost, not amortized or impaired. That is wrong. Intangible asset can be shown at cost or fair value model, but there must be an active market. So which is true is intangible asset should be amortized in according to expected pattern of future economic benefit. Option C is the answer. Again, the next one is also again a theory question. Which two of the following statements are true in accordance with IAS 38 intangible asset? A company must use revaluation model for intangible asset if revaluation model is being used for tangible non-current asset. No, false. It has nothing to do with tangible non-current asset. Intangible asset is a separate accounting standard. Company should revalue all material intangible assets. That is again not true. So we got the answer. If A and B is not the answer, then definitely C and D will be the answer. But let's read it to make sure it's correct. Revaluation of intangible assets should be done only if there is an active market for such asset. That is true. Initial measurement of intangible asset must be at cost. That is also true. So C and D is the answer. 23rd one. What is the total amount which will be charged to statement of P&L for the year ended 31st March X7 for project Quantum in accordance with IAS 38 intangible asset? So always be very careful with the year end. 31st March 20 X7. So year begins on April X6 and ends on 31st March X7. So read the question. Zilio is conducting the following research project as of 31st March X7. Project Quantum, that is our question. What amount will be charged to profit and loss account? You know the amount that will be charged to profit and loss account with respect to intangible asset are basically three things. One, research expense will be shown in profit and loss account. Two, development expenditure before criteria met. Development expense before criteria being met. And the third one is amortization. So now let's read the question. The project started on 1st May X6 with a total cost of 12 million evenly accrued till 31st December X6. So 1st May 20 X6 to 31st December 20 X6. How many months are there? May, June, July, August, September, October, November, and December. There are basically 8 months. 8 months. So 12 million has been incurred from 1st May to 31st December X6, 8 months. So what will be the expense of 1 month per month, how much will be the expense? That is 12 million divided by 8 months. Per month expense is equal to 1.5 million. Evenly accrued means you can time proportion that 8 months. On 30th July XX, the board members confirmed that project fulfilled capitalization criteria. So the project started from 1st May 20XX, and it met the criteria on 30th July XX. So till that date, its expenditure before criteria met, it will go to P&L. How many months are there? May, June, and July, 3 months. So 3 months expense will be expensed off because it is before criteria met. So 1 month is equal to 1.5 million. So 3 months is equal to 4.5 million. So this will be shown in profit and loss account. The question is asking how much amount will be expensed off. Then from 30th July, it have met the criteria for capitalization, then it will be capitalized as an intangible asset till the project is completed. And the question has very clearly stated that the project, when was the project completed? On 30 July XX, and you know the expenses given till 31st December XX. So from 30 July XX to 31st December 20XX, you have the balance figure, 5 months. July, don't take it. It's 30 July. So August, September, October, November, December, 5 months. So 1 month is equal to 1.5 million. So for 5 months, it will be 7.5 million, or you can say the balance amount is capitalized as an intangible asset. So if this is capitalized as an intangible asset, it must be amortized, and amortization will go to profit and loss account. So 7.5 million, we have to know when it started production. If production date is given, we have to start amortizing from the production date. So the production date is given on February X7. And financial year ending is 31st March. So from 1st February to 31st March, there are basically 2 months. So this must be amortized for 2 months. What is the useful life of the project? The project is expected to generate revenue for next 4 years. So 7.5 million divided by 4 years in a time proportionating amortization 2 by 12. So let's use a calculator to find out how much is the amortization. So 7.5 million is the amount of intangible asset capitalized. Divided by 4 is a useful life, multiplied by 2 by 12, time proportionating 0.3125. So amortization is equal to 0.3125 million. So amortization will be shown in, as you know, profit and loss account. So the amount that we have to show in SOPL is the expenses before criteria met, that is 4.5 million, plus amortization 3.125 million, that is equal to 4.8125 million, which they have given option A, 4.81 million. So moving forward to the next question. Classify the following as true or false for accounting treatment of projects Pinnacle and Navigo under IAS 38 intangible asset. So now let's read about the project Pinnacle and project Navigo. The project started on 1st August X6. Cost of $25,000 per month was spent until 28th February X7 when the project was cancelled. So this project got cancelled. So every expense that has been incurred on research and development should be written off to P&L. The unique equipment procured for Project Pinnacle was transferred to be used in other research projects by Zillow. So they had an equipment which was being used for Project Pinnacle. Since the Project Pinnacle is scrapped or cancelled, this equipment was transferred to other projects. Project Navio, the project began on February X7. Cost of 45,000 per month were incurred until 30th September X7, when directors increased the budget of $70,000 to expedite the project completion due to identification of a potential buyer on 15th August X7. The success of the project was uncertain until this point. So till 15th of August, the project was uncertain. That means as on 31st March X7, Project Pinnacle was uncertain. So as on 31st March X7, it cannot be capitalized. It will go to profit and loss account. Now let's read and the statements and see whether it is true or false. Project Pinnacle's cost should be treated as an expense in statement of P&L for the year ended 31st March 20X7. Is it true or false? It's true. It should be treated into profit and loss account because the question very clearly says that it has been cancelled. It has been cancelled. So since the project is cancelled, it have to be written off to profit and loss account. That is true. Second one, the specialist device procured for Project Pinnacle should not be depreciated as it is exclusively used in the research project. That is false. The specialist device, it can be depreciated. Its equipment can be depreciated. It's false. The expenditure incurred for Project Navigo should be reported as an asset in statement of financial position at 31st March X7. That is wrong. As on 31st March X7, it was completely uncertain whether the project would be successful. So it should be written off to P&L. It cannot be capitalized. So the statement it can be capitalized as an asset is wrong. It's false. Moving to the last question of scenario number 2. In the year ended 31st March X8, Zillow company incurred the following cost. The question is asking, according to IAS 38 intangible asset, which of the above costs should be capitalized as intangible asset? 1. $350,000 in personal cost to maintain a computerized list of potential customers. No. Personal cost, etc., and that too potential customers list, that is an internally generated intangible asset, it cannot be capitalized. So 1 is not the answer. Second, $700,000 to acquire a domain name for selling Zillow company's website. Yes, they have acquired a name. They have purchased a domain name by paying money. It's a purchased asset, so it can be capitalized. $3.5 million for a patent to enhance manufacturing process. So they paid $3.5 million to acquire a patent. So it's a purchase. Cost is there. So definitely it is an intangible asset. So 2 and 3 is the answer, option D. Moving on to the last scenario, which is pretty much small scenario. Let's read the scenario first. Vance obtained a loan of 1.25 million dirhams with a maturity of 2 years on 1st September X5. Remember, the financial year ending is on 31st December X5 and some event is occurring on September. So maybe there could be a time proportionment, September, October, November, December, 4 months. Maybe let's read the question. The loan has an interest rate of 7% payable at the time of loan repayment interest. So definitely we'll have to time proportion the interest, 4 months. The loan was planned to be utilized to construct an office building, which will take 16 months to complete. The construction of building commenced on 1st September X5. The building will cost 600,000 to construct on a piece of land that will cost $350,000. Exchange rates are as follows: September X5, 1st September to 31st December, 31st October, 31st December X5 figures are given. Vans provides services to clients in which the time period for fulfillment of performance obligation spans 3 to 5 years. Performance obligation over a period of time. Vans recently experienced some losses which may lead to recognition of deferred tax asset for the first time since company's incorporation. What will be the accounting model of measurement of 1.25 million dirhams loan in accordance with IFRS 9 financial instrument? So the question is regarding financial instruments. They have issued or obtained a loan, so it's a financial liability. There are three methods to measure financial liability at the year end in SOFP. One is amortized cost method. Second one is fair value through P&L method, not three, sorry, two methods. So when will we use amortized cost method? Amortized cost method will be used when the entity issues a loan or loan note or a bond or take a financial liability for the purpose of cash flows. And if it is for trading or speculative purpose, then fair value through P&L. So this loan is taken to construct an office building. So it is taken for the purpose of cash flows. So amortized cost method will be used. Option B. Next one. What will be the carrying value of foreign currency loan at 31st December X5? And they're asking in dollars. So we'll have to convert this. So let's first find out what is the value of this loan on 31st December X5. So on 1st September 20X5, they took a loan. So that is a liability. So the liability amount, loan liability amount will be 1.25 million dirhams. I'm showing first all the figures in dirhams. Then later we will convert into dollars. $1.25 million dirhams. Now they're asking 31st December. So from 1st September to 31st December, interest also need to be paid. So the loan amount will increase, the liability amount will increase. So 1.25 million multiplied by 7% is the interest rate. But the loan was taken on September. So from September to December, September, October, November, December, multiplied by 4 by 12. Why are we adding interest? It's very clearly stated that the loan has an interest rate of 7% and payable at the time of loan repayment. So the interest is not paid yearly, it's paid at the time of repayment. That means the loan amount plus interest amount will be the liability. So the loan amount of 1.25 million and interest for 4 months from 1st September to 31st December will be shown as liability to be paid at 31st December X5. So let's use the calculator to find out the interest. 1.25 million multiplied by 7% multiplied by 4 by 12 is equal to 29,166.667. So 29,166.6667. So we can say 67. So the total amount of liability on 31st December X5 will be plus 1.25 million plus 29,166.67. That is 127. So the loan which have to be shown as liability at 31st December is 1.279, 166.66. Now this is in dirhams. We have to convert this into dollars. Now for that, we have to identify whether it is a monetary amount or a non-monetary item. Monetary item means amount receivable or payable in foreign currency. Since this loan is repayable along with interest in foreign currency dirhams, it's a monetary item. Monetary item should be retranslated at year-end at closing rate as per IAS 21. So what is this dirhams? So what is the closing rate? The closing rate on 31st December X5 is 4 dirhams. You have to cancel dirhams. So you have to divide by dirham. Then dirham and dirham will get cancelled. So that is 1,279,166.67 divided by 4. That is equal to 319,792, 319,791. We got our answer. Option B is the answer. So moving forward to the next question. Classify the following statement as true or false. The building should be retranslated at closing rate at 31st December X5. That is wrong. Building is a PPE. It's a non-monetary item. Non-monetary item, if it is shown at cost model, then it will be retranslated at rate on date of transaction. If it is being shown at model, it will be retranslated at the date of revaluation. The building is not, or a non-monetary item is not retranslated at closing rate, so that is false. The loan should be retranslated at closing rate as at 31st December X5. That is true. We have learned that the loan, the amount payable in foreign currency, is a monetary item, and as per IAS 21, monetary item have to be retranslated at closing rate. That is true. 29th question. In which two of the following scenarios will the revenue be recognized over a period of time in accordance with IFRS 15? The customers simultaneously receive and consume all of the benefit provided by entity as the entity perform the performance obligation. Yes, that is true. That is how we have to record over a period of time. The entity's performance or accomplishment does not create a resource that will be of economic benefit in future. C, the customer has a legal right to omit promised offer of the entity after agreement period. No. The entity performance create or enhances an asset that customer controls as the asset is created. Yes. Option A and D is the answer for this particular question. And moving on to the last question. In accordance with IAS 12 income tax, which two of the following will lead to, read the question very carefully, non-recognition of a deferred tax asset? So the most important question is that when will you record a deferred tax asset? A deferred tax asset with respect to a loss, the question is with respect to a loss, will be recorded in two situations. One, there's a chance that entity will make profit in future, probable profit or probable future profits. And there is tax planning opportunities available. So in this two situation, we can record a deferred tax. They're asking which two of the following will lead to non-recognition of a deferred tax. There's a permanent difference. Now you have to remember, deferred tax is a temporary difference. How do you calculate deferred tax? Temporary taxable difference into tax rate. If there is a permanent difference, then there is no deferred tax. There have been previous years of significant profitability. There is a history of recent losses. If there is losses, then you cannot record a deferred tax asset. Of course, you can record a deferred tax asset when there is loss, but there must be a probability that in future entity should become profitable. If there is a history of recent losses, it indicates that the entity will not become profitable in future. So deferred tax asset cannot be recorded. There will be sufficient future taxable profit. That means you can record a deferred tax if there is profit. So which two of the following will lead to non-recognition of deferred tax? Option A and C is the answer. So we have solved the entire section B of pre-September 2024 mock exam. I hope you have understood this. All the best for your September 2024 exams. And don't forget to subscribe to this channel as I'll be posting more debrief videos on AA, SBR, and other topics related to mainly FR, AA, and SBR, the subjects that I teach. So thank you, everyone. All the best for your exams. Goodbye.